Happy Wednesday and welcome to Buy Right, Borrow Smart Live, the live version of our podcast where we get together here every Wednesday to answer your questions and to cover everything mortgage, real estate, economics related that impacts buying or selling a home and financing a home. You're going to notice I am alone this week. Mr. Jeb is in the Grand Tetons on a big adventurous hike, so he won't be able to join us. So let's all wish him well and that everyone in his group makes it through safe and sound. But with that, let's jump in to the slides here. So you'll notice the topic for tonight's show is your mortgage rate just moved. Here's what the government did. So if you've been around here for a while, you know that neither Jeb nor I are big fans of government intervention. Whenever the government steps in, puts their thumb on the scale, sometimes good things happen, but there's often, almost always, unintended consequences there, and the unintended consequences are what we want to avoid. So you probably had noticed today that we had an announcement from the Treasury that they were going to double their buying of Treasury bonds. So there was a flurry of responses, thoughts on this, that this is terrible, that we're going back to QE or quantitative easing. Some of the things that have pushed home prices up or did through the pandemic, that quantitative easing that went on for far too long and pushed home prices to the unaffordable levels that they are right now. And there was some fear with that. So you can see here this from the Wall Street Journal. Bessent leans into his role as America's bond trader in chief. What did they actually announce? They are stepping in, and this program actually started under Biden when Yellen was the Treasury Secretary. And this is not quantitative easing. It's a liquidity move where there are certain Treasury bonds that are less liquid, and if the owners cannot sell them, then their money is out of circulation. So you've probably seen the headlines here recently, 19-year highs in the 30-year Treasury. So the 20-year and the 30-year, really, really high. Short end of the curve has improved some. Middle of the curve, where your mortgage rate sits, kind of has been stagnant for the last couple of weeks. So in mortgage terms, this doesn't mean a whole heck of a lot to you. But what they're doing, they're going to probably sell bonds at the short end of the curve, 2 years, 3 years duration, to then buy these less liquid bonds at the long end of the curve. So it's a net zero impact there. They're borrowing to buy. So this doesn't create cash. It's not quantitative easing. They're not buying mortgage-backed securities. They're not doing any of that. So in the short run, we did see about a 25 basis point improvement, not in interest rates, but in mortgage-backed securities today. So depending on what note rate you're at, less than 1/8%. But what we can see here made a really big impact on the 30-year Treasury. That 30-year Treasury that had hit 19-year highs dropped a bunch this morning and then held the gains and actually improved some throughout the end of the day. So we got to ask ourselves why. Why are they doing this? And this headline here, also from the Wall Street Journal, was interesting to me. It says, why Scott Bessent is playing with the Treasury market. The simple explanation for all of this is that the world is going into a new era of capital need for data centers, the military, and reshoring. And it almost sounded like the author here, James McIntosh, was pulling his thoughts directly from Lacey Hunt's most recent quarterly newsletter, where he shifted from being a 40-year bond bull, biggest bond bull in the room, meaning he thinks that rates are low and staying low and moving lower, to believing that we're now heading towards an era of persistently higher interest rates, not meaning 10% interest rates, but here, possibly a little higher, possibly times where they're a little bit lower, but persistently higher interest rates after a 40-year nothing but down market. And the reason here is that we have a supply of cash around the world that's going and less supply of money than there is investments looking for investors. So those investors are able, whether they're investing in financing data centers, military, anything, they're able to get a greater return. So what they're trying to do here is essentially manipulate interest rates and keep them lower than they otherwise would be, primarily at the long end of the curve. And again, your mortgage, although we talk mostly about the 10-year Treasury, and we'll look at the 10-year Treasury chart here when we get through the slides, the most important thing for mortgages is either the 5 or the 7, and the reason is duration. Most people will sell their home or refinance well before 30 years, so mortgages more closely follow the 5 and the 7. So what do we have here? Bond yields dive after Bessent steps up. It's basically the same chart as we had there earlier. I had another chart here. I think I just mistakenly put that one in here. So let's buzz through what Jeb goes through with you guys here every week. National single family inventory up 1.2.8% year over year. So essentially flat week over week, 865 from 871 to 871 from 865. So 6,000 more homes on the market week over week, year over year. Very, very little difference in terms of what we're looking at there. And here in terms of total single family listings, we're at 68,125. Very, very consistent with what we've seen over the last couple of years. So not a whole heck of a lot of news there. Weekly pending sales, those homes that are for sale, how quickly are they coming off the market? 65,202, a little bit below where we were last year, a bunch below, not a bunch, but I think a couple thousand below where we were in 2024. So more of the same, more of a malaise here in home buying. This new normal of these lower levels that we've seen post-COVID. So percentage of properties with price reductions, the price cut percentage at 41.67%. It's trended up a little bit here, but essentially the same as where we were last year. It looks like if we can expect the normal seasonality, it's going to level off here throughout the remainder of the year. Mortgage spreads did not do anything. The spread between mortgage rates and the 10-year Treasury, which we just talked about, hasn't really done anything week over the week, a slight improvement, but nothing significant to talk about here. So again, there was the other chart. It was just a different look. We have this buyback announcement. The Fed announces they're going to buy the long end of the curve. This is the chart of the 30-year Treasury yields. We went from 5.33 somewhere in that range down to 5.2%. That's a pretty big dip for a single day, but again, not indicative of much for us on the mortgage side. So let's look at the things that do actually move mortgage rates, that move interest rates. It actually moves the entire yield curve. Part of the reason why we're seeing long-term bonds so high is that we don't have a belief as an economy that that the government is serious about getting spending under control. But let's look at inflation and how that impacts things. So last Thursday, after we were here on Wednesday, we had producer price inflation. It was down or a flat month over month after down 0.1. So this is a much better figure. They were expecting a 0.2 increase month over month, and we didn't get it. That was a positive. Producer price inflation year over year, you can see this is still a problem. 4.7 is way above where we want to be. Even when we were down here at the beginning of last year, November, December, January of 26, 3.3. That's still above where we want those numbers to be, and we're well above that now. So good news on the week over week or month over month, but year over year still well above where we want to be. I believe it was Friday we got retail sales. Retail sales came in way below expectations. There were some caveats here, but it's still well below what the market was expecting. And why do we look at this? Again, for mortgage rates, those of us in the mortgage industry, we're the vultures of economic news. Bad news is good news. So low retail sales is not good for stores. It's not good for consumers because they're not out buying stuff. May not be good for them in the long run in terms of having jobs if the consumers that they sell to are not buying stuff. But when we look at this, it tells us that the market, the economy itself is not overheating, which back in March, we had a really big number there. But this has been close to flatline if we average this out over the last year, and that is a positive. If we see year over year, 4.9% up year over year. We had seen it dip and definitely run back up, but moderating over the last few months. There were some fears that hot retail sales were indicative of a hotter economy than what we're thinking and possibly more inflation in the chain. We also just this morning got the open Federal Reserve Open Market Committee minutes, their notes from the last meeting, July 28th and 29th. So just a couple things to note here. Several participants favored a 25 basis point rate hike. That's not news. They talked about that in the press release. Many believed additional tightening could become necessary if inflation didn't decline. We're seeing it decline, but nowhere near quickly enough. Some felt financial conditions weren't restrictive enough to bring inflation back to 2%. I would argue with that just in the sense that the things that they control, raising interest rates is not going to slow inflation. There's other things going on here. 3 voting members dissented in favor of hiking rates. We knew that. They announced that. They put it in the announcement in their terms of transparency here under Warsh. That's substantially more hawkish than the next move is obviously a cut. No duh. So again, another look here at inflation. We like Truflation's figures. It gives us a current read on it. You can see both of those are essentially flat, but flat well above where we want them to be. We had got well below 2% in both of them within the last 12 months. And CPI, their measure of CPI is at 2.3. Their measure of PCE is at 2.66. Either of them well above the Fed's target of 2, even though they're lower than what we're seeing in real time in the BLS numbers. This is a new one that they've thrown up here. I thought it was interesting. I thought I would put it in here. You may have heard new Fed Chair Warsh talking about possibly using the trimmed mean price index. They take out the extremes of measures that are on the high end or the low end, gives them a better look. And I guess if we squint really hard, we can see this is trending downwards, but it basically shows the same story that we were looking at otherwise. Now, the big picture inflation, Cleveland Fed's nowcast this week, still projecting 0.35 month over month, 0.34 in PCE. Anyway, you cut it, those numbers are well over 4%. We're not seeing the improvement we need for interest rates to come down much. The news that we talked about in the last week, good CPI figure, good PPI figure, weak retail sales, tells us that we jumped up a little bit in the probability of doing nothing from 59% last week to 67%. So we do get a good bit of data. It's not till 9/16, so we're almost a full month away from that next Fed meeting. So there's certainly plenty could happen. We could get a hot CPI read next month, hot PPI. Any number of things could happen that could turn that around. But as of right now, it looks like they are out of play for the next meeting. Throw this chart in here because you see the big red candle over there to the right. We did see in the 10-year Treasury that does more closely track mortgages and mortgage-backed securities. We saw some nice improvement based off of that Treasury buying today, but we could almost draw another trend line way above the bottom red line, and you can see it there. This is about the low end of that trend line. If we don't see some follow through in the next couple of days, it doesn't mean anything for us on the mortgage side for those of you buying houses. I wanted to show you guys this week. Just show you day by day. Since we were here last week on the 12th, dropped a little bit. The low for the week was 6.69 on the heels of that PPI figure last week. We're at 6.72. Really nothing happened week over week. 6.72 on the 30-year, according to Mortgage News Daily. FHA and VA, a little over 6.25. Most of our clients are still looking at government stuff under 6.25. That's 6.625, 6.75, depending on your credit score. And the conventional is pretty reasonable and realistic. If you haven't been out and checked out our new website, get a look there for the reason that it's pretty cool. You can ask questions. Where we have you see right there in the top nav bar, ask a question. There's a library of 2,700 questions Jeb and I have answered, and it will give you an immediate answer unless we did not answer your question, in which case it'll shoot it over to the two of us, and one of us will get back to you. I'm trying to pull my headset off here. One of us will get back to you, whether it's a real estate or a mortgage question. But more importantly, you can also take the quiz there. It takes less than 2 minutes, less than 10 questions, and it will tell you exactly where you are in the process. Are you ready to buy? Are you getting close? Are you a little bit of a ways away? But more importantly, it gives you a PDF curriculum, also immediate access there to it online based off of your score of what you should be doing right now to put yourself in the best position to buy a home now or in the future. And it will also give you a custom 10-episode playlist of the episodes of the podcast that are going to be most applicable and helpful to you. So go check that out. We would love for you to see it. It's buyrightborrowsmart.com. The quiz is at buyrightborrowsmart.com/quiz. So let's get back over here and see what questions we have here so far. We have the usual suspects here. Dixieland checking in from Minnesota, giving us a happy Wednesday. First question here, the relatively easy one. Saba Mohammadi 8416 says, any estimate of when we can see a 5% interest rate? Nothing on the horizon is telling us that's coming. We're still seeing the impacts of tariffs, even those are moderating, seeing the impacts of high fuel costs. So we have inflation well above where the Fed wants to see it. Employment has been weak, but not weak enough to really pull down interest rates appreciably. So what would have to happen? What would we need to see? Spreads are just under 2%, either just under or just over 2%, meaning that if we want a 5% interest rate, we need the Treasury at 3%, and we're more like 4.75%. That is a big move. We've been under 4 several times post-COVID, 385, 395, somewhere in that range, but it's been just for a couple days and then flips and goes back the other direction. So quite a ways would be the answer. I would not expect it this year. Possible next year, but what we would have to see is a weakening economy, weakening jobs market, and most importantly, inflation under control. So check back, come here every week. We run through the data, we track it for you, watch the show, and we'll keep you posted on that. Always a reminder, if you guys have any questions, anything you would like for us to go through and answer for you, throw them in the comments here. If you would like to get connected with a realtor in Jeb's network anywhere around the country, if you would like to get connected with me and my team to help you on the mortgage side, we have a link there where you can get started with your own personal roadmap. We like to go through what your max qualification is, make sure you qualify for what you would like, get you side-by-side numbers of a couple of different options that will meet your goals, and most importantly, show you what the all-in payment is, total cash to close, to give you more information so that you're making educated decisions and not just guessing with some of these online calculators. So you can get that at jebsmith.net/start. You can also get it at buyrightborrowsmart.com/start. Either one will get you over to our team, and you let us know you want help on the mortgage side, help on the real estate side, help on both. So Willing is back as always with some questions here. Not sure, Willing, what your actual question here says. As one borrower has a credit score of 650 and the other one that they know qualify, explain to them how they no longer qualify for a promotion with a minimum 700 credit score. So I'm assuming you have a lender who's doing improved pricing. Willing is in the mortgage business. There are often times that lenders will do incentives for certain groups, whether it's a income tier, whether it's a credit score. Most credit situations in the mortgage space are going to come down to the mid-score, the lower mid-score of 2 borrowers. So in this situation, he's got 2 borrowers. One of them has the 700 credit score. One of them doesn't. In almost all situations, the lender is going to use the lower mid-score to tell them which one they're going to be using. Lisa Marie kindly chimes in and says, "Hi, Josh. Hello to you." It's one of our local realtors, a friend of Jeb and I. So thanks for checking in and watching the show. So I love the anecdotal evidence here. So Ben chimes in with seeing lots of foreclosures popping up for sale, plus lots of price drops. Do you think we're going to see more of this moving forward? I'm not sure where you would see foreclosures. It's not in the data. It's not in our MLS locally. It's not showing up in any of the MLSs. The only data that I have seen showing any distress is FHA 90-day delinquencies are up about 50 basis points year over year. So other than that, not a whole lot of evidence of that. Price drops, we can see the price drops. You see in the chart here, we always want to talk about what we're showing in those charts is national data. So nationally, 41% of homes are having price cuts, which tells you that 59% of homes are selling at their asking price or above. So still more selling above than below. It is a more neutral market. What we're seeing is the nice homes, the upgraded homes, the homes in the right school district, even the homes that need work. If they're in a trophy location in a great neighborhood, they're going to sell. The things that are getting price cuts are the things that need work, that aren't in the best location, that aren't in the best school district. And that's a little bit with broad strokes. That's in the stronger markets. We are seeing markets around the country where homes are seeing cuts to move. But even in the weakest of markets, those trophy homes are still doing well. So Ben, I would just be super careful with thinking that you are seeing foreclosures because the data is just not showing it. And we see it not only nationally, but in the local data. There's nowhere really around the country that is showing that. So Natalie has a comment here. Thanks for your insight. Appreciate the information. Well, we appreciate you being here. Appreciate you being here. If it wasn't for you guys here showing up and asking questions every week, we wouldn't have anything to do. Chris with a similar comment, first time viewing, like what I see so far. Well, hey, we appreciate you being here. If you have any questions, anything mortgage or real estate related that we can help you with, let us know. again, here, Houston and Conroe, Texas has a lot of foreclosures. If Jeb were here and I could dig into the data and pull it up for you, we're literally, it's just not there. What are we considering a lot of foreclosures? It's not a lot historically. It may be a lot compared to where we were 3 or 4 years ago, but it's not even a large percentage of the market because homes are not getting that far in the process. We're seeing a little bit of 30 to 60 day delinquency, some which is serious delinquency, which is 90 days or more. For a foreclosure to actually happen, someone is getting a year or two into that process. Most lenders are willing to do loss mitigation and try and keep people in the home. They've learned their lesson from being really aggressive while getting government bailouts to not risk the moral hazard of helping people during the GFC. And they've learned their lesson and do a really good job of keeping people in homes if there's any hope of them actually being able to stay in the home. So not a whole lot of questions, guys. I know without Jeb here, I've gone through it a little bit quicker, went through the charts a little bit quicker, even though we did talk about Besant at the top. So if you have any questions there in terms of what's going on with interest rates, besides when they're going to hit 5%, what's going on in the mortgage market, any loan programs, questions about you qualifying, income. We talked last week here on the show how we are in the process of pulling our actual book together from 230 episodes of the podcast, about 27 chapters, 300-page book. We have covered just about everything, and it's been interesting. So as you guys are asking these questions, many of them are things that we've been going through here. So Matt Hatfield has more of a comment here. 2010 to 2020, annual sales hover around 5 million units per year. Post-COVID, annual existing home sales now hover around 4 million units. It has been there. And the expectation every January when we get to everyone's forecasts is that this will be the year that we get back to the mid to high 4.5 million. And just haven't seen it yet. So 5 million is normal based off of population size. It's what we would expect. It's lower for a couple of reasons. First of all, the lower affordability, but also for the simple fact that a bunch of demand got pulled forward during COVID. People who would be buying now are now have already been in their home. So we've seen Gen Z and millennials bought at higher rates than what they otherwise would have been expected to during the COVID timeframe because it was more advantageous and more affordable. Many of them were able to take advantage of that, and many that didn't have been priced out. So definitely seeing a lot of that. So a real good question from Ray Favis 1000. What is the rule of thumb for deciding whether to let a bank foreclose? So I'm assuming that you're saying as a homeowner, when am I better off having the foreclosure or doing a deed in lieu of foreclosure, which is me deeding the property back to the bank if they will accept it without having to go through that foreclosure? Those are treated the same going forward. It's the same damage to your credit, but it needs to be a little bit faster, easier, cleaner. The other option is potentially negotiating a short sale. A short sale is where the bank agrees to take less than you owe because they look at that home and they say, we don't really want to own it and have to turn around and sell it. We would rather work with you and get what we can out of it. So that's sort of that waterfall or cascade. They want to look, the bank wants to look, and you probably want to look. Is there a modification here that makes sense? Am I suffering some type of temporary issue here that I'm going to recover from, and in the future I'll be able to make this payment? So do I need temporary forbearance where I don't have to make a payment for a few months till I get back on my feet? Do I need something where we're going to give me forbearance on my interest, where my interest rate is lower and we tack that on to the end of the loan? The example that I like to use and why this is not happening at scale is the very first home that I flipped in 2008. We bought from a trustee sale. So I bought it at the courthouse steps, and we had to go to the house and talk to the guy about getting the keys and getting him out of the house. And he told me a couple things. He had paid $685,000 for the house less than 36 months before we bought it. I had bought the house at the courthouse steps for $265,000. So he had bought it with 100% financing, an 80-20 mortgage, and it had a 228 ARM, which means it was fixed for 2 years, a true teaser rate. And what had happened is by the time that adjusted, home values had stopped going up. It was worth less than he owed. He could not get a new loan. Those 228 loans did not exist. Stated income loans did not exist. So there was no financing his way out of it. And he had a home that he owed more than $400,000 than it was worth. And his payment was about $5,000 or $6,000 a month. I don't remember which one it was, but it was a lot. And I asked him, I said, hey, do you see that house across the street? Is that house less nice or nicer than yours? He looked at it, he goes, that house is a lot nicer than mine. So same neighborhood, similar house, similar size. I said, do you see the for rent sign? And do you know how much they're asking? They were going to rent the house for $2,000 a month, and he was paying $5,000 a month. I said, you could continue paying the lawyer that is fighting for you to stay in this home, and you're going to lose. So whatever money you pay him is money gone. That's great for him, not so great for you. Or we can just be done with this. And he gave me the keys and he moved out by Friday because he realized he could get a nicer home for half of the cost. And he had not lost anything other than his credit. So by that, what do I mean? He was going to have a foreclosure on his record, but he didn't put any money down. He's going to a better situation. So in that, we have these situations where it makes all the sense in the world to go through a foreclosure. Now, right now, if your home is worth 500, you bought it for 300, you have a 3% mortgage on it, and it's going to cost you $500 or $1,000 more to rent than what your mortgage is. Those people are going to want to fight and stay. And again, as we said, lenders have every incentive to try and work with you and keep you in a home if they can see a light at the end of the tunnel for you to stay in that. So Willing back with another question. If you had the opportunity to assume a mortgage, if you were a veteran, you don't have to be a veteran to assume the mortgage. So you just have to have a veteran who is willing to let you assume your mortgage without you replacing your eligibility in place of theirs. Because you can use that, you can assume their loan, but their entitlement is still going to be encumbered until you sell the home or refinance and do another loan. So it says, would you, looking into assuming another residential mortgage, would you, or is it tricky mess to get involved in? 2.75 interest rate, mortgage balance 235, and the home selling for 395. So the last part is where we get into where it gets really, really hard. Most people looking to buy $400,000 homes don't have $160,000 to put down. Most of them don't have 20% down. If you did, you could get a second mortgage for the difference, which is going to be 7.5% today, 8%. So it mitigates some of that 2.75 difference. So it really just depends. If Jeb was here, he could tell you the story. Less than a year ago, he had a local here who passed away. The veteran had passed away, so they didn't care. You don't need to substitute your entitlement. Oh, I'm cool with anybody taking over this loan. But it was a different situation. Southern California property, owed about $1 million, probably was worth about $1 million and owed like $600,000. And they found someone who had that big down payment on the $1 million property. They came in, they took over a 2.75 mortgage, and that was very, very valuable to them. So there is a process. It is a little bit hairy. There's no loan officer involved. There's a person at the lending, the servicer, who has to manage that process, and it can be cumbersome, difficult, time consuming. But again, if you have the down payment, if you have a way to finance that gap, you have a family member that wants to make a private party loan to you, it can be a great situation for you to get to that situation. So Ben has some more anecdotal evidence here. A friend of mine is a sales manager at a big car dealership. He's noticing people are starting to clam up a little bit, and he said banks are also tightening up, a little harder to get approvals. Mortgages and auto loans are very, very different. Yes, the auto is secured, but it's secured by something that moves around a little bit harder, and it's also generally depreciating versus an appreciating asset. So lenders there will tighten up long before mortgage lenders do. And you've seen the numbers, just like we see the numbers on housing. We see the numbers on auto sales. Auto sales continue to be down. Cars are more expensive and they're higher quality, so they last for longer. People are making their cars last longer, just like they're staying in homes longer. The average tenure in homes when I got in the business in 1995 said the average person will be in their home about 7 years. Last we saw the numbers, that's up to about 12 years. So definitely extending out over time, people doing the same thing with cars, and it's definitely hurting car dealers from that end. So again, just reminding you guys, if you have any questions, drop them in here. We don't have a whole heck of a lot of them. I don't have Jeb here to bounce some things off of. We usually have some things that would be of interest to you that the two of us can discuss. Don't see a whole lot on my radar right now that's super interesting to you. But definitely let us know if you have any questions here. I will hang out as long as we see questions coming in. But if it's a light one here at the end of the summer and you guys are all out having fun before the days get short and we're in the fall, definitely understand that. I would say what am I doing here? Take another look. If you have a minute, go out, check out the new website. Tell us what you think. You can get questions answered. If you're too shy to ask them here, you can get immediate answers there to your questions. Like I said, 2,700 or so questions. You get an immediate answer. If it's not something that we've answered or it's not a high confidence response to your answer, then it will come back and get it to Jeb and I. Willing, you're the only one asking questions, so we'll go with some of your crazy questions. What is your favorite kind of tree? I don't have a favorite tree. I have don't really know. You're saying, does an evergreen tree make you think of Wolverine or Strider or Ranger of the North? I would say a redwood. I am fondest of a redwood tree, big, tall, old, many things like myself, but that's what I got. Joyce has an actual on-topic question. The deficit certainly doesn't help the situation as it reportedly now passes 40 trillion, more than doubling in a decade. So that is the other headline that when we were titling the show today and pulling it together, that I was looking at before the Treasury stepped in. I think the Treasury stuff trumps the 40 trillion, no pun intended. But 40 trillion is a really, really big number. The thing to remember, just like looking at $1 million house doesn't mean what it used to in terms of home value. 40 trillion isn't what it used to be, but it is a spectacularly large number. The more important number, or the thing that I focus on or that concerns me more, is the interest that we are paying every year on that debt. So the debt gets bigger, interest rates are higher, so we have more of the federal budget, more of the money coming in, going to just pay and service the interest. And the most insane thing that I saw of the day is that Ro Khanna and Bernie Sanders came up with the brilliant idea that we should tax billionaires 5% on their wealth. Some of you may agree with that. Some of you may believe that. And I said, okay, so we're going to take 5% from billionaires so we can pay the deficit down. We can get our house in order. We can do that. Oh, no, no, no. They want to give everyone in the U.S. with households that make less than $150,000, just give them $3,000. So take it from one person, give it to someone else. Like this, what this would be like is you're like, hey, I'm my debts are out of control, but I just got a big inheritance, or I just won the lottery. Let me go buy a lot of stuff and instead of helping get your debts under control. We can debate whether we need to raise government tax receipts, but the idea that we would just take that in and go ahead and give it away is a little bit insane. So Ben has another question. Can you get a DSCR loan on a rental property if it needs some work? Generally, the same guidelines. They want it to be in good and habitable condition. It's not a rehab loan. It really comes down to health and safety issues. We say it needs some work. It's dated. It needs a new bathroom. It needs an updated kitchen. Needs new carpet and paint. If it needs a new roof, but the roof's not leaking, you just can't really get like a rehab loan with a DSCR loan. But the way we're going, someone will probably come up with that product to help investors do that. So Justin, this is one of my favorite comments that we see regularly. Sellers are still delusional and prices need to come back to reality. Sellers don't set the price of homes. Sellers can ask what they want. I could go ask $10 million for my house, put a sign in my yard. No one is going to show up and give it to me. The price of homes is determined by a willing seller and a willing buyer of what they agree to in the open market. So if you're looking around and you're seeing homes coming for sale and selling at prices that you don't like, there's no one delusional there. That's a market working. Talk about 41% of sellers are finding out that they are coming up with a price that's unrealistic, and we have to get more realistic with a price cut to get to a buyer who's willing to clear that home and take it off the market. And there are delusional sellers that sit down the market for 6, 12, 18 months and never sell and eventually take their home off the market. But when you look around and you say these homes are too expensive, if people are buying them and they're coming off the market and you don't see home prices coming down in your area, it's telling you you're unable to afford in that area, not that prices are too high. We've seen on the second comment there, wages need to go up a lot. Wages have gone up more than home prices have the last 3 to 4 years. So when we look at it, we can certainly debate. Everyone would like wages to go higher, but then you have wage-based inflation, interest rates are higher, home prices go higher. It's not as simple as just saying, hey, everyone needs to make more, or home prices need to come down. We have a limited supply of homes. We have enough people wanting to buy them, even when there's only 4 million of them a year, that in most places around the country, we're still seeing prices go up, although minimally, and 1-2% a year around the country. So Willing also follows up that they like palm trees and Christmas trees. I don't think anyone is going to argue with any of those things. We've got 47 questions from Willing that I'm not sure that anyone is going to stick around and listen to. So we got a bunch of you listening. A bunch of you just came in here in the last few minutes. If you just got here and you have a question. So Justin, this isn't a debate. Sellers are not delusional unless their home doesn't sell. If they put their home on the market for the comparable price in line with the comparable sales and the home sells, so massive price cuts, okay, then that seller was delusional. But you're saying all sellers are delusional. They're not. Homes are selling. We're not seeing inventory back up in a massive way anywhere around the market. And some of that is the delusional seller that says my home's worth $1 million and the market says it's worth 750, and they just take it off the market and they keep it because they owe 500 and they have a 3% mortgage. So yeah, there's enough demand to keep prices where they are around the country. But again, if you just tuned in, you have some questions, we'd love to answer them. If we don't get a whole lot of questions, do have a few more calls to make. We'll get on to those. Jeb will be back next week after his 40-mile hike. Hopefully he will be feeling good and not too beat up from that end. So yeah, I'm just making one last pass here to see if there's any questions. If you guys don't have anything, we will let you go. Enjoy the week. We'll be back with some additional. Oh, we're getting an Amber Alert. That's nice to have that in the middle of this. So hopefully you guys are not having Amber Alerts where you're located. Hopefully they find the child wherever they're at. Ben does have another question. Is 20% down the requirement for DSCR? There are lenders that do offer less than 20%, Ben, but the key part with that, when you put less, it's very hard for the DSCR to work. For the debt service coverage ratio to work, the rents have to exceed the payment. There are negative DSCR loans, but it's sort of a different animal. And then we start looking at a bigger down payment requirement. So from that, that's what we got. You guys have a great week. We will be back next week, hopefully with Jeb in tow, and we'll go from there. All right. Buy right, borrow smart. Adios, amigos.